Very good afternoon to one and all. Thank you for choosing to spend your Saturday afternoon with us. My name is 𝗪𝘆𝘀, and I'm the Senior Director of Wholesales here in Singapore at Netesys Investment Managers. And I'm really pleased to be able to be joined by my colleague, and he's 𝗪𝘀𝘀. He's the Senior Investment Specialist of Loomis Sayles, and Loomis Sayles is an affiliate and a wholly owned subsidiary of Netesys Investment Managers. Now, obviously, today we're going to really explore a very interesting topic. It's all about unlocking the growth in US equity markets with Loomis Sayles, and more importantly, with one of the flagship funds that Loomis Sayles actually carries on FSM, and that would be the Loomis Sayles US Growth Equity Fund. And why are we talking about, unlocking the growth in the US markets? I think, most of us here would know that, the S&P 500 index has actually done really well over the past 2 years, averaging at about 25% to 26%. So the very one obvious question that everybody would be asking is there upside still in the US market? And how do we actually, approach growth equities or growth stocks in the US market? So for the next 20 minutes, I'm going to grill 𝗪𝘀𝘀 because he's really the expert in Loomis Sayles products. And a quick shout out, about this fund that we're going to showcase. The Loomis Sayles US Growth Equity Fund is CPF ordinary account approved. You can use your CPF monies to actually invest in this fund. And it's really one of the rare funds out there that has actually outperformed the S&P 500 over the last 1, 3, and 5 years on average. And lo and behold, I was actually very surprised to actually find out that over the last 3 years, this is the top 1 percentile in terms of ranking across 770 large cap US competitors. So very, very compelling track record. But before that, I really wanted to quickly introduce the firm that I am from, Netesys Investment Managers. And I'm pretty sure some of you here have not actually heard of us. Now, if you have not actually heard of us, we are really huge. We manage in excess of $1.4 trillion worth of assets under management, right? And that puts us to be one of the top 20 global asset managers in the world today. We are dual headquartered both in Paris as well as in Boston. But I think what really is the key value proposition of Netesys Investment Managers is the fact that you can think of us like the 𝗪𝘃𝘃 of investments. Now, why do I say 𝗪𝘃𝘃? I think all the women here, or maybe most of the women here, love 𝗪𝘃𝘃 because really it's the holding company of the luxurious brand Louis Vuitton. But not only does 𝗪𝘃𝘃 carry Louis Vuitton, it also carries other brands, luxurious brands like Da Vinci, Celine, and Chloe. Now, Netesys Investment Managers is that 𝗪𝘃𝘃 because we not only carry Netesys funds, but we carry 18 different boutique managers under our belt. And Loomis Sayles is really one of them. They are very strong in growth equities as well as fixed income. So maybe on that note, I shall pass the time over to 𝗪𝘀𝘀 to actually introduce Loomis Sayles.
Thank you, Flora. And it's so nice to be here. Loomis is just about 100 years old. In 1926, Mr. Loomis, Mr. Sayles, actual guys, during the electrification, the industrialization of the United States, realized, yes, there was an awful lot of money to be made by identifying these winning investments. But it was just as important to avoid the losers. In a world where there wasn't a lot of information, in a world where there was privileged access, you really kind of had to do your own homework. This is the moment where Moody's comes out with their first credit rating scheme. A company that's meant to provide unbiased information. We didn't even trust them. We came up with our own. So Loomis is thought to have the second oldest credit rating scheme in the country. In other words, from day one, almost 100 years ago, fundamental company-specific research has been the core of what we do.
I don't know if you caught that, but how old is Loomis Sayles? They are almost 100 years old, and they're really, really good at bottom-up stock picking. Now, before we embark on the first question, and we haven't actually embarked on the first question, but this is a US growth equity fund. And let's just, pull ourselves back and take a look at what the general public actually thinks of growth investing. I think growth investing, right, or growth investors, we are really less excited about the present stock price because we think that the future growth of the company is going to more than compensate for the present stock price. So we are very excited about the future growth prospects. And given that Loomis Sayles has 770 large cap competitors out there, how different is Loomis Sayles' approach when it comes to growth investing? Maybe Jonathan, you can talk more about this.
And I think we do think differently about growth. Look, a lot of companies grow. A lot of companies are profitable. It is the very rare business that can grow those profits for more than just a few years. That's the kind of business we want to own. And maybe it will come as a surprise, but it's not the absolute level of growth that matters most. It's the persistency of that growth. Real value comes from owning companies who can compound those profits over the long term.
Yeah, so it's really like what Jonathan mentions. You have many growth managers out there, even 769 of them, but really we're not just looking at growth, we're looking at the persistency of growth. And companies that are able to grow are those not just over the next 1-2 years, but over the next 10 years, you are looking at secular tailwinds or secular business drivers that support, really the growth of such companies like AI, healthcare, online advertising, which we will talk about later. And, we just wanted for Jonathan to really quickly give us a quick overview of the 3 key value propositions of the Loomis Sayles US Growth Equity Fund. So, Jonathan?
So I'm going to focus on the focus. The 3 things that we require in order to buy any business are quality, growth, and valuation. Quality is very simply difficult, if not impossible, to replicate businesses. You generate lots of revenues, you're profitable, you're inviting capital and competition to come. And if there isn't a barrier to entry, if there isn't a way for you to defend your place in your industry, all those extra profits get competed away. So what does quality look like to us? Things like brand and scale, distribution scope. It could be manufacturing expertise, an ecosystem, a network effect. For us, growth, it has to be both profitable and sustainable. And we're typically forecasting growth 10 years or more. Quite extraordinary, and that really differentiates us, doesn't it?
Of course, because most of the managers out there will only give you the outlook for 1 to 2 years, but really, this is an ownership model where we look at companies for 10 years, and that culminates in a very, very nice performance. So if you take a look at this slide here.
But just let me make one additional point.
Yes, okay.
Because growth being sustainable, what we think really helps there is that the growth is driven by something secular in nature. So we are looking for a secular growth driver that provides a tailwind for this growth for potentially a decade or more. Things like AI, yes, absolutely. E-commerce, online advertising. But it doesn't always have to be things that are technology. How about air travel? Air travel has been growing above GDP for 40 years.
Absolutely, and what I wanted to mention is, with this very long-term approach and the fact that, we buy not only quality companies that have persistent growth, but at the right price, this culminates in a very, very nice performance, right? Not only top 25% of our peers, like I mentioned, we are actually the top 1% across the last 3 years. Last year, the S&P did about 25%, we outperformed, we did about 33%. And over the last 3 years, on average, it was about 13% in terms of returns, a tripling that of the S&P 500. So very, very good performance.
So if you think about the 3 things, quality, growth, and valuation, the valuation is simply buy these stocks when they trade really cheap. Each of those things, quality, growth, and valuation, happen about 1% of the time. All three of them happening simultaneously is incredibly rare. So rare that we only have about 35 companies in our portfolio, and we don't trade very often. Last year, we bought one company. In 2023, we bought one company. In 2017, we didn't buy a single company.
I'm very curious what that company was that you bought last year. We'll ask you later. But, let's take a step back. I think one of the very popular questions out there that I hear a lot of investors asking me is, there's going to be Trump 2.0, and yes, interest rates are coming off, but we are still facing a higher inflationary environment. So how is the Loomis Sayles US growth equity strategy actually navigating such an environment?
We really invest for the long term. About 50% of our portfolio predates Trump 1.0. Actually, a third of our portfolio dates back to the Bush administration. So presidents come and go, but these secular growth drivers, online advertising, diabetes, sending your data to the cloud, productivity software, Monster beverage, energy drinks, these are secular growth drivers that will be in place for a decade, maybe even several decades.
Yeah, so, these are the top 13 stocks in the 35 stock portfolio, and you can see that it actually constitutes more than 50% of the portfolio. Does Trump matter? Does a higher interest rate environment matter? It really doesn't matter. Like what Jonathan mentions, we have bought all these 13 stocks, or even more, at a very, very good price more than 10 years ago. Right. So let's move on to another hot topic, which is really, one of the questions that people always talk about. They talk about the fact that, S&P 500 is dominated by your big tech names, and they call them the Magnificent Seven, right? And that has, that's easily at least more than 50% of the S&P 500 in terms of the index right now. And the rallies that we have seen over the past 2 years was due to the fact that the Mag 7 have actually gone up quite a bit. So the next question is, are we positioned for the broadening out of the Magnificent Seven? Because a lot of people think that, the rally will broaden out of the Magnificent Seven. And maybe a more pointed question to my Loomis Sayles colleague is, if you look at the fund itself, the US Growth Equity Fund, actually we own 6 out of 7 of the Magnificent 7 stocks. The only stock that we don't own is Apple. So tell me, are we going to sell the Magnificent 6? Because people think that, the rally is going to broaden out of these stocks, right?
Yeah. Well, before I answer that question, okay. 2 observations. First is the Magnificent 7 represent 6 different secular growth drivers. So what is it that really ties these businesses together? The second observation is, in 2022, the Mag 7 were anything but magnificent. Amazon was down 50%. Meta was down 65%. When companies that big trade down that substantially, it means just about every investor out there is selling. And what were we doing? Adding to our positions. So onto this chart. We have owned Amazon since day one, over 18 years ago. And in that time frame, on 14 different occasions, the stock has dropped between 20 and 60%. Yet despite those exceptional drawdowns, over this time frame, Amazon has outperformed the S&P 500 by almost 20 times. In other words, the only way you really benefit from the great growth these businesses can give you is if you actually try to hold them. So Flora asked, are we going to sell these? They're all up a lot. And my simple answer is no. But maybe there is something that ties these names together. These are amongst the very few businesses who have demonstrated an ability to grow their profits over the long term. And we very much expect them to continue to do so, which means we very much want those 6 companies still in our portfolio.
Absolutely, right? Because we bought these 6 companies or even more at a very unmagnificent price when it was unloved. And I think that is the true worth of a long-term investment approach, that you not only buy these great names, but you buy them when they're down and out, and you buy them even more when the market thinks that they're not great at all. So that works really well for Loomis Sayles. And pulling back from really the macroeconomic landscape, could you quickly share with us a stock story success that Loomis Sayles is actually proud of?
So I want to talk about NVIDIA, but before I do that, we have to talk about artificial intelligence. This represents one of those exceptional structural changes to how our economy works and how we live our lives. PCs in the 1980s, the internet in the dot-com era, smartphones. In these moments, the market tends to make 2 mistakes. One is they underestimate just how vast the potential adoption of these new technologies are. Investors tend to think about the next 12 to 18 months. They're certainly not thinking where this technology will be in 10 or 20 years. I have enough gray hair to remember the dot-com era. I certainly didn't think every aspect of my life was going to be executed online when I think about where we are today. The other mistake investors make is they overestimate the number of companies who will profitably deploy the technology, who will allow companies to be able to use this. Think about it. No company is particularly special because they have a website, or no company is special because they have PCs on their desks. AI is going to become ubiquitous. The companies who really make money here are the ones who allow it to happen. And you think about it, every single data center out there is furiously adding capacity so that they can offer AI capabilities. Who are they buying their chips from? NVIDIA. And you think it's just a chip, can't somebody else do that? Well, they invented it 25 years ago, and 25 years later, it's them and one other company. This is incredibly difficult stuff. Even if you could replicate the superior performance, we think you also need an ecosystem. 5 million chip programmers know how to exploit the functionality of this chip. And a software advantage. 300 coding libraries. You buy a GPU chip tomorrow, you can start implementing that AI in your business almost immediately. So here's a company where the growth, quality elements are there. The growth is clearly secular. Couldn't be more profitable. But the stock is up thousands of %. Isn't it too expensive? Why are you still holding it? We would argue that there is still so much more to go. Here's a company that constantly innovates, takes all of that cash, reinvests back in the business to defend and extend their competitive advantages by making their chips better. So what has that meant? Each new chip takes market share from Intel and AMD. In other words, more of the profits are available to NVIDIA. And as they continue to innovate, harder and harder to replicate, extend their competitive advantage period, they earn those profits for longer, which is why NVIDIA, at the top of our portfolio, lots of investors ask us, NVIDIA's done really well, it's your #1 holding, what's your next NVIDIA? It's NVIDIA.
Yeah, absolutely. There are many EVs out there, but only one chip powers them, NVIDIA, right? So very quickly on sectors, any sectors that Loomis Sayles finds interesting and why?
Mm-hmm. We are long-term investors. You should really think about us as an ownership strategy. If you could go back. You should really think about us as an ownership strategy. These are the businesses we are very happy owning for the next 10 years, even if we couldn't trade them. And I think that's really important. We only buy when quality, growth, and valuation come together. That can be anywhere in the economy. Next slide. And an important way that we manage risk is owning numerous secular growth drivers. Our view is, by diversifying those sources of profits, you can really help when markets go down.
Absolutely. I think the growth drivers are more important than the sector allocation. And very, very quickly, before we end off, I just wanted to ask you one last question. You talked about NVIDIA, you talked about Amazon, you talked about several other tech companies as well. Why don't we just buy the S&P 500? Why should we buy the Loomis Sayles US Growth Equity Strategy and Fund?
I think the one thing I would say is think about that Amazon example. When the stock is down 50%, think about the Meta example. When the stock is down 65%, we can go out there and buy more of it. An ETF can't. There is still room for active management to really generate extra returns for portfolios.
And that culminates to a very, very good track record. Like I mentioned, this is the #1 percentile fund across the last 3 years, beating the S&P 500 index across the last 1, 3, and 5 years on an annualized basis. Okay, and it's CPFIS approved. Thank you so much for your time. For more information, please actually come and look for us at the booth behind. Thank you.